listening to Estate at the Union, estate planning made simple. Here's your host, Brad Wiewel, from Texas Trust Law in Austin, Texas.
Hi, this is Brad Wiewel with Texas Trust Law, and this is the next episode of the Estate of the Union. And today I'm just going to talk about understanding estate taxes, the death tax. I'm going to make this short, I'm going to make it simple, and hopefully by the end of this program you'll have a really good understanding of how death taxes work, estate taxes work, and how gift taxes work. How about that? So we're going to throw a little gift tax stuff in here. And usually people only think about gift taxes when they're playing Monopoly, and you come to the little square that talks about luxury taxes and things like that. This is not Monopoly. This is real stuff. But I'm going to make this simple, hopefully. And again, by the time we're done with this podcast, which will be a fairly short one, you have a really good idea of how they work and whether you'll be impacted and how you can avoid maybe getting impacted. So let's start with what's an estate tax? What's a death tax? A death tax is a tax that you pay. Actually, you don't pay. Somebody else pays for you when you die and you have assets in excess of the limits the federal government gives us, the IRS, our good friends of the IRS. Currently, the estate death tax exemption for individuals is just shy of $13 million. We're going to round up and say it's $13 million per person in your lifetime. If you're married, get 2 exemptions. That's $26 million. Unfortunately, couples who are living together and not married only get 1 per person, and it's a good reason, frankly, to get married, because if the wealthy spouse marries a less wealthy person, they get to pick up their estate tax exemptions. That's a pretty handy little thing. So if you got a lot of money and you're living with somebody and you may be in a category you otherwise could have an estate tax issue, if you get married, you get now 2 exemptions. That bumps up to $26 million. That's a lot of money. Most people don't have that. Most people don't have $13 million. But those that do, anything over that is taxed at 40%, 40%. And frankly, that's why people don't like this tax. This is a tax on things you've already paid taxes on. This is what you got left at the end of the day, and the IRS comes in and takes it. Now, $26 million, $13 million, that's a whole lot of money. In January 2026, those numbers are scheduled to drop in half to $6.5 million per person, $13 million per couple. Again, that's a lot of money. Most people don't have that much money. If you don't hit those limits, you don't have to worry about estate taxes ever. Could they lower them further? Yeah, they could. Will they? Who the heck knows? They can't seem to find their butt with both hands up there in Washington right now, so I have no idea what it's going to be later. But the law that gives us a $13 million exemption is scheduled to plummet and be cut in half January 1st of 2026 unless Congress changes the law. Will they change the law? Again, who the heck knows? I don't have a crystal ball. I don't have an 8-ball. I have nothing. But we'll see. Be prepared. Be alert. When I started practicing estate planning in 1997, the exemption was $600,000, folks. And married couples only got 1 exemption per couple unless they did some estate tax planning. So it's gone up a lot, and it may come down. We'll see. The truth of the matter is they've never lowered the estate tax exemption ever, because there are plenty of rich Republicans and there are plenty of rich Democrats, and nobody likes this tax. So we'll see. We'll see. But if they do, again, be prepared. And as a viewer of our podcast, we'll keep you posted on any changes that might occur that would have an impact on you too. Let's go to this thing about the exemption and what does the exemption cover? What is the IRS going to tax? And the IRS is going to tax everything that you control anywhere on the planet Earth. We had a workshop last night. In fact, to let you know, we're doing workshops around the community. We had a workshop last night, and a lady was there from France, and she has property in France. And the question is, if she has property in France and she passes away, is the property in France added to her estate for estate tax purpose? And the answer is yes, it is. It's worldwide. One thing people don't think is in their estate is life insurance. because they were told perhaps when they bought the life insurance policy that life insurance is tax-free. Well, it's income tax-free, it's not estate tax-free. If you have a life insurance policy, that will be added to your estate and potentially taxed at 40%. There are ways, pretty simple ways, to move life insurance out of your estate and put it in a special trust called a life insurance trust, and then it's not taxed. But that takes work, that takes effort, that takes inertia on your part, and it takes some fees that you're going to pay us to put that in place, but it's a pretty common technique. So again, to remind you, everything that you own or control on the planet is added all together. If it's more than the exemption, there's a 40% tax. And by the way, speaking of the past, the 40% tax could go up. When I started estate tax planning again in 1997, it was a $600,000 exemption, and the estate tax could go up to 60%. Yeah. Could those come back? Again, who knows? Bill Clinton wanted to take it from 600,000 to 200,000. So we don't know. Stand by. All right, let me kind of give you the essence of how this tax works with lifetime gifts. So we have clients who have done well, and they want to take some of the assets that they've got and gift some to their children. Fine, you can do that. You can give anybody you want to $17,000 this year. If you're married, you can give $34,000 to anybody on the planet that you want to. If you make a gift during your lifetime, they get it. They don't pay taxes. If you're keeping within the $17,000 limit, $34,000 you're married, you don't pay tax, nothing happens. It's a free transfer of wealth. Over the course of time, you do that year after year after year, that adds up to a lot of money. So it's a kind of an easy technique to use to kind of, over the course of time, lower your assets and lower your vulnerability to an estate tax. But when you give more than $17,000 a year to somebody, then you get into the world of gift taxes. And gift taxes are something nobody ever thinks about, but we think about all the time, and CPAs think about all the time, and your friends at the IRS think about all the time. If you make a gift to someone over $17,000, let's say you give somebody $117,000. The $17,000 is free, but the other $100,000 is potentially subject to a gift tax. And the gift tax rate is, guess what, 40%. But, and this is what I want to talk to you about today, because this is how gift taxes work with estate taxes. You don't pay gift taxes until you've gone through your entire exemption. And the $13 million exemption you get on estate taxes is the same exemption you get on gift taxes. So unless you give somebody $13 million over the course of time, or give in gross gifts to many people, a total of $13 million over your lifetime, no gift tax at all, because you're using your exemption. I think the best way to illustrate this, and I've racked my brain of the best way to illustrate this, is a gift card. Now this is a Chick-fil-A gift card, and it only has about $10 on it right now. It doesn't have 13 million on it. Wouldn't that be nice? That'd be a lot of chicken. The way the gift tax works with estate or death taxes is as follows. Let's go back to the illustration I just gave you. If I've got 13 million on this gift card because it's my gift card, I'm an individual, and I want to make a gift to somebody of 117,000. I make the gift. The 17 goes free. The $100,000 over the 17, I have to take off my gift card. So I go to 7-Eleven, I swipe this gift card, and instead of having 13 million on the gift card, I have 12,900,000 on the gift card, because I've used my gift card while I'm alive to make a gift. Well, it's a gift card. I've used it. I don't pay anything. If I go to Chick-fil-A and run this thing through for a $9 meal, I've got $10 on the card. At the end of the day, I don't pay Chick-fil-A any money, and I still have $1 left on my card. Again, that's how it works. If I make a $100,000 gift in excess of the $17,000, the IRS makes me swipe the gift card, and I've only got 12,900 left. So when I die, I don't have 13 million left. I have 12,000,009 left because I swiped the gift card and made a gift to somebody over and above the 17,000 while I was alive. That's how it works. So you can gift as much as you want to, as long as you want to, for as many people as you want to. With the 17,000, nothing comes off this gift card. But once I give more than that, then I have to swipe the gift card and tell the IRS that I swiped the gift card. And the way you tell the IRS that you swiped the gift card is by filing a gift tax return. And you may not even know that this exists, but there are things called gift tax returns, like there are estate tax returns, like there are income tax returns. You file a gift tax return with the help of your CPA. Don't try to do this on your own. They're complex. And the gift tax return ultimately, with, again, a fair amount of complexity, tells the IRS, hey, I swiped my card for $100,000. I've got 12,900 left. And they'll put that in their file and say, thanks for letting us know. That's all that happens. When you die, again, if there has been swiping of your gift card while you're alive because you're making gifts more than the annual amount, more than the 17,000 this year, then that'll show up. And again, that comes off the gift card, off your lifetime exemption, and that's what you got left. So if you want to give your kids money to buy a house, a $500,000 house, swipe the card, file the return, you'll have a little bit less to use, a little bit less on your gift card when you die, but you won't be paying gift taxes. Then when they receive it, they won't pay any tax either. It's an easy and smart thing to do sometimes. Gifting money, this is why we do gifts. Gifting money is important in a large estate because once you give it to, we'll just say the kids, then it's their money, not your money. And the real issue is we're moving future appreciation out of your estate. So if I got $1 million and my $1 million is growing at 10% a year, every year now I've got $1,000,001. The second year I got $1,000,002. That will all be taxed if you're over the limits at 40%. But if you give it to the kids, that $1,000,001, $1,000,002, $1,000,003 is growing in their estate, not your estate, and you gave them the money. So I'm not going to go into smart ways to give kids money right now. I want to keep this presentation short and relevant and simple, hopefully simple. So I'm going to stop here with this example, but I do want you to know there are many, many things we can do here at Texas Trust Law to avoid estate taxes, death taxes. The thing to keep in mind about death taxes, estate taxes, is that they're voluntary taxes, literally voluntary taxes. If you do the planning, you don't have to pay them. If you don't do the planning, you may have to pay them. Again, you won't have to pay unless you're over the limits. The limits right now, $13 million per person, $26 million per couple. In tiers, maybe $6.5 million per person, $13 million per couple. We don't know. That's still a lot of money. Most people won't have that kind of money. Don't worry about it. If you do have that kind of money and you want to start working on this, because here we are expecting a rush. We're expecting a flood of people starting next year who want to come in and get this stuff done before January of 2026, and we only have room for so many people. Only have room for so many people. So if you want to get on this, get on it. Okay, we're happy to take your call. We have to find a time in our schedule to get you in here and work with you on this and try to save estate, gift taxes, death taxes, whatever. So happy to help if we can help. First says it's free. Thanks for listening, and hopefully this is helpful, and we're always happy to educate you on many things, and we'll have more podcasts coming up soon. Thanks.